Hey everyone, and welcome to This Explainer. I want you to imagine waking up tomorrow morning, you check the pre-market, and you see that the world's absolute biggest AI companies have just shed hundreds of billions of dollars in market cap overnight. The question hanging over Wall Street would immediately shift from a quiet whisper to an absolute roar. Are we just seeing the greatest wealth creation engine of our generation taking a quick breather, or is this the perfect setup for a historic market crash? It's a scenario that seems almost impossible when everything's going up, right? But the actual mechanics of the market tell a much, much more complex story. It's kind of the defining financial question of our current era. Is artificial intelligence just another massive bubble? Because here's the fascinating reality. Some of the sharpest, most clued-in institutional investors in the world aren't just sitting back enjoying this rally. They're actually sounding the alarm. They are drawing very direct, data-driven parallels between today's AI frenzy and past market manias that ended in really steep corrections. And these aren't just perpetual bears. These are quantitative analysts looking at valuation multiples, and they're seeing massive red flags that the everyday retail market is just totally ignoring right now. Just picture the ripple effects of that hypothetical nightmare. Nvidia crashes, broader tech stocks plunge, literal fortunes wiped out in a matter of hours. If that sudden rush to sell actually happens, the implications for the global economy are absolutely massive. We're talking about pension funds, your everyday retail portfolios, and massive institutional capital all taking a hit at the exact same time. So to understand if this is a real, looming threat or just some pessimistic noise, we really have to dissect the unprecedented environment we're in and look at the underlying math. Okay, let's dive right into this with Section 1, the trillion-dollar boom. For the past couple of years, artificial intelligence hasn't just influenced the stock market, it has completely rewired the whole thing. And it really boils down to one word with a capital T: trillions. That is the sheer, frankly unprecedented scale of value that AI-connected companies have added recently. We're not talking about small, incremental gains here. We are looking at a fundamental shift in how money moves, with astronomical wealth flowing straight into the infrastructure of a single sector. And that kind of concentrated capital, it's incredibly rare, and it alters the gravity of the entire market. Excitement is literally everywhere right now. It's a multi-front gold rush. Everyday investors are pouring money into AI stocks, heavily driven by headlines and, let's be honest, a huge fear of missing out. At the same time, entire governments are unlocking massive public funds, treating AI dominance like a matter of vital national security. And the tech giants, they are locked in an all-out arms race. They are deploying historic amounts of money to build out infrastructure, buy specialized chips, and construct vast data centers at a scale that totally defies traditional corporate budgeting. And this brilliantly illustrates our next point, Section 2, Echoes of the Dot-Com. This brings us to why we really need to look backward to look forward. Because while the AI tech is brand new, human behavior, well, that is timeless. Back in the late 1990s, investors had this absolute unwavering certainty that the internet was going to change everything. And you know what? They were completely right. But when you compare that 1990s internet boom directly to the 2020s AI boom, the identical psychological frenzy is just undeniable. The massive influx of speculative money, the fear of missing out, ignoring traditional metrics, it's exactly the same today as it was back then. And this presents a seriously dangerous paradox. The technological predictions of the 90s were totally correct. The internet did revolutionize human existence. Yet, millions of investors still lost their shirts when the dot-com bubble burst. Being right about the underlying technology doesn't magically protect your portfolio from a massive crash. A company can succeed in changing the world, but completely destroy shareholder value if everyone paid way too much for the stock. So today, analysts are asking, could AI follow that exact same path? Which leads us perfectly into Section 3, the cost of expectations. To get why these crashes happen, we've got to unpack how a market mania actually works. Whenever excitement hits a fever pitch, investor psychology shifts. In a normal, boring environment, a rational investor asks, okay, how much profit does this company actually generate? But in a bubble, fundamentals kind of go out the window in favor of momentum. People just ask, how much higher can this stock go? Bubbles are built purely on unchecked expectations. And when you decouple a stock price from its actual revenue, you create a very, very fragile financial structure. And this blind reliance on expectations eventually collides with a massive, tangible roadblock: the sheer cost of AI. Building advanced frontier models, that costs billions in R&D alone. Running those systems, paying for the crazy amounts of electricity and compute power, billions more. Expanding them to meet global demand, it just compounds exponentially. These AI companies are burning through literal mountains of cash right now, betting on a future that hasn't fully materialized yet. It's a massive gamble. So that brings us to the absolute most critical question in the market today. What happens if those profits arrive just a little slower than everybody expects? Investors are currently pricing these stocks for absolute perfection, assuming massive future revenues are a sure thing. But if there's even a slight delay, if businesses take just a bit longer to adopt the stuff than Wall Street demands, those massive valuations lose all their structural integrity. When a stock is priced for a decade of flawless growth, even a tiny hiccup can trigger a massive sell-off. So the absolutely crucial point to remember here is this. Markets crash when reality fails to meet expectations. Markets don't usually crash just because a technology is flawed. They crash because the reality of the revenue just can't scale fast enough to reach the impossible expectations investors have priced in. If you buy a great company at a terrible price, it's still a terrible investment. And right now, growth expectations for AI are practically touching the sun, leaving literally zero margin for error. All right, let's pivot a bit for Section 4, Revolution Beyond the Bubble. This is the part people often miss. History proves that real technological revolutions don't just vanish because the stock market has a panic attack. Think about it. The internet obviously survived the dot-com crash. Smartphones survived their early market doubts. Cloud computing, e-commerce, they thrived after initial volatility. AI will absolutely survive a market correction too. The underlying technology is going to march forward regardless of what the stock ticker is doing on any given Tuesday. And that's because the utility of this tech isn't a mirage. Just because a stock gets caught in a bubble doesn't mean the product itself is fake. AI is already actively changing how the world operates right this second. It's automating tasks, massively increasing productivity, and creating entirely new opportunities across industries, from healthcare to logistics. The real question isn't whether AI will change the world, it already is. So here is the vital difference you have to wrap your head around to navigate this market. The technology isn't fake. The companies just became overpriced for a period of time. Recognizing that nuance, the difference between a temporary market correction and a true, unstoppable technological revolution, that is the ultimate key to surviving all this volatility. The winners of the next decade will be the folks who can separate real technological progress from market hype. Ultimately, it comes down to being rational versus being emotional. History teaches us that revolutionary tech creates generational wealth, for sure, but extreme excitement pushes prices way beyond reality in the short term. The people who actually build wealth in these moments, they rarely follow the emotional crowd off a cliff. The biggest winners in this AI era will be the investors who stay fiercely rational, focusing on actual metrics when everyone else is lost in the hype. Right now, being rational is your ultimate competitive advantage. So we're back to where we started, hopefully with a bit more clarity. Are AI stocks the undeniable future, or are they the next massive bubble waiting to burst? Well, the profound truth is, it's highly likely to be both. The technology is very real, but the current price tag, that might be an illusion. So what do you think? I would absolutely love to hear your take on this paradox, so let me know down in the comments. And if you enjoyed this explainer, please subscribe for more data-driven insights. See you next time.